Happy October, everybody. Great to be back with everyone. My name's Stuart Scholten. With me today, I've got my partner, Brian.jarosinski. If you've been with us before, welcome back. We do these podcasts or shows, as we like to call them, on a quarterly basis. And, we have a fun time updating you all on just some current events, things that are going on in the market. We'll get into a market review here in a second. But for those of you that maybe haven't participated in one of these shows before, just a couple housekeeping items. As we always like to say, we love kids and dogs, but we just don't want to hear them on the call today. So please stay muted. Brian and I know we both have newborns in the house, so we deal with this on a daily basis, just in the background. So second item, I also just want to mention, we love participation. So you're going to hear us pause from time to time. We're going to get to questions in the chat. I know a lot of the topics that we cover tend to be more complex. This is obviously educational, so maybe you've heard some of these concepts in a general sense before, but we really look forward to digging in and kind of getting into the nitty gritty. So if you have questions, don't be shy about getting into the chat. We'll get to you. And then also want to highlight our email address. If you want to get in touch, or maybe you need a more personal consultation, something that's a little bit more nuanced to you, the address is planning@mywellcents.com. So I know we'll get that in the chat as well. If you've participated or you got this link, it's because your employer is leveraging WellCents. So WellCents is a financial planning service that's offered by NFP, National Financial Partners, as your financial advisor. WellCents is our program, and you've got an opportunity to engage with financial professionals on our team for more of those personal consultations and the app-based interface. So keep an eye out for those emails. We'll be coming to a location near you for an on-site or virtual appointment. So without further ado, Brian, I know we want to get into a little bit of a market update, lots of things going on globally, domestically. I'll let you give a quick introduction of yourself and then take it away.
Yeah, thanks, Stuart. Look, it's great to be here as always, once a quarter to give you guys as much wealth of information as we can. And as we do these throughout the quarters, certain things are more in the forefront, right? Like when we do the first quarter one with tax season upcoming, and this one's before the end of the year. So we're going to talk about a lot of things you should be thinking about if you haven't already for your year-end financial planning. But always a pleasure for those of you who are first joining. Again, I know Stuart introduced, but again, certified financial planner, been doing it 20 plus years. So our goal with these again is to be very interactive. Make sure you have the chat open. If you guys can't hear, or I think I saw one post on there, or one chat rather. If you have any issues technology-wise, shoot us a message as well. But otherwise, we'll get into it, right? I mean, look, the market, certainly at this point, last year, the market was worse than it was today, year to date. So just kind of going over some stuff that's in the forefront. We all know all the horrible things going on in the Middle East with Hamas and Gaza and, all the unrest globally with all that stuff. For year to date, just I pulled some numbers for the call. The S&P 500 year-to-date's up 12. The Dow's only up 2. We'll talk about that. The NASDAQ, and why we'll talk about that a good bit, is that's up 27%. For those of you who aren't familiar, the NASDAQ is the major index that tracks tech stocks. So you really have the big 7 in there, right? From Apple, Microsoft, Amazon, Google, Meta, Nvidia, those kind of folks. But that's really what we've seen so far this year. And many of you have probably seen it if you follow this stuff or watch the news, is the market's up, but as a whole, if you look at the S&P 500 is the best indicator we have for our stock market, right? It's the largest 500 market cap size companies in the country. So far this year, if you equally weighted all 500 stocks that are in the S&P 500, not based on their market weight size, which is what most of us see on the tickers on CNBC and MSNBC, our stock return this year is 0. If you look at the equal weighted index. So, well, Brian, how does that make sense? So they said the S&P was up 12. The S&P that you and I normally see on, again, the TV stations, on our phones, Yahoo Finance, etc., that's what's called a market weighted index. So, for example, I think like in Nvidia and Apple and Amazon and those kind of companies, those are the big 7. I think account for almost 25% of the index at this point, because those companies are so large. So if you look just at the top 7 companies this year, they've done on average around 55%. So they're kind of propping up the stock market, if you will. So that's important for a lot of reasons. We'll talk about it as far as making sure you're in the right places in your 401k plans and doing things in your IRA. But I gave a seminar for one of our 401ks yesterday, in person actually, which was a nice change of pace versus doing these virtually. And one of the participants was like, Brian, I just don't feel like I'm making any money in the last couple of years. And I'm like, well, I'm right there with you. Because if you look at the S&P 500 value today versus all the way back to June 2021, the S&P is the same exact price. So we literally have gone up and down, and we're basically flatline from those two data points. So Brian, I get all that. So what do we do? What do we, how do we kind of row our way through the turbulence? And I'll let Stuart jump in on this as well. But really what we always tell people is, again, the market is always volatile. That's why we get better long-term rates of return. But if you're still 15 plus years away from using the money, it's all about when you're going to use the asset and get paychecks from it and draw from it. If you're 15 years away, you always got to make sure you stomach the storm and you make sure you're diversifying in the right ways. And that's where, again, you reach out to a Stuart or myself or your personal planner. But I'll throw it back to Stu with just kind of going over the market updates and seeing what he's hearing from clients, and again, put things in the chat. But that's really what we've seen this year. I will end real quick, and Powell just came out again and said inflation's still really high. So before he came out a month ago and said he plans to keep these interest rates really, really high, which we're now north of 5%. They're now talking again and again. Ultimately, between you guys and us, they're just politicians. So ultimately, they're probably gonna. Well, now what they're saying now is they may have a couple more rate increases. So we'll continue to watch that as well.
Yeah, I mean, just to echo Brian, I think it's also, we harp on this with every client, stay the course, really try to leave the emotions out of it. Even if you're somebody who's near retirement, I think this is a concern for everybody, not just if you're in that 5 to 10 years from retirement range or you're retiring in the next year, but I mean, even for somebody who's in the middle of their career, it's hard to stomach as your account balance grows over time, those big drops in the market. And a lot of time it can feel like, hey, I'm continuing to put money into my 401k or my IRA every couple of weeks or every month. And why is my account not going up? That's a common thing that I hear. And so being, really cognizant of the fact that there is volatility, that's normal, that's part of being an investor. Also try to keep in mind that pullbacks from time to time can be a really good thing in the long run. So, sometimes I think maybe a lot of us have heard the term dollar cost averaging. So it's this idea that if you're consistently putting money into the market at fixed intervals, fixed dollar amounts, you're buying more shares when the market's down in value. So you're kind of buying at a discount, and then less shares, obviously, with that same dollar amount when the market's up. So the good news is, as the market grows over time, those investments that you're making when the market's down, that's what's going to double and triple in value over the next 20 to 30 years as you kind of go on down the line. So kind of keeping that approach, I think sometimes like, hey, this is the best time to be putting money into your retirement plan when the market's down, because that's what's going to give you the most appreciation potential over the next 20, 30, 40 years and into retirement. So really staying the course, thinking about the long term. And even if you are at retirement, that portfolio's got to last you the next 20 or 30 years. You're not taking all that money out on day one. So you still need to maintain and stomach some risk just to make sure you don't outlive your assets or you don't spend through it too quickly. So, that's my 2 cents on it. And really, again, it's something that we talk about with everybody. We have to remind ourselves that, even as professionals in the industry, we have 401ks too. We have investments that are fluctuating. So, we're all in the same boat is what I like to say. Stock market, obviously kind of ties in more broadly to what's going on. I know we also wanted to touch on the housing market a little bit. I'm sure we've got people on the call that are, maybe looking to buy or looking to move at some point. What are your options with where rates are at? And I think it's, one of the few times over the last, several decades that it's actually cheaper to rent than own in most places, unless you're putting a very hefty down payment down on a property. It can make sense, I think, to really stay in that rental position and, wait for rates to drop or continue to save more money for a bigger down payment. So there's just some interesting things going on there with the real estate market. As Brian mentioned, with rates staying high, at least for the foreseeable future, it'll be interesting to see if maybe there is a pullback in the housing market as people, maybe have to look or they do have to move in certain situations, or if there's more broad unemployment, what that looks like. But that's kind of where we're at right now. So a lot of houses are sitting on the market for longer. The market stays elevated because the demand is there, but rates they certainly don't seem to be going down anytime soon. So Brian, anything you want to contribute, and
Yeah,
what are
I
you
just want
seeing
to
on the
hit
real
some of these. So
estate?
look, we already got a lot of stuff coming across the chat here. So couple things, right? We got Denise saying, what if you're 5, 10 years from, what if I'm 10 years, I'm sorry, 6 to 10 years from basically needing paychecks? What if I'm 3 to 5? What if I'm 8 to 10? Virginia also popped in here and said, what if I'm retiring early 2024? So holistically, first off, as your focus is shifting from accumulation to income, and again, as Stuart was mentioning, with longevity and life expectancies going up, with health, health care improvements, we want to make sure that we're shifting our focus towards retirement in the right way. And we all probably remember the lost decade. So, Brian, what was the lost decade? From 2001 to 2010, the stock market returned a grand total of basically 0%. So that has happened before. So once you get within that, literally that 10-year window, that's where we start to make some adjustments with clients. So I would say if you have a put it this way, a 20,000 foot view statement. If you have a portfolio you plan on needing income and driving income off of within 10 years, and you're sitting in all stocks, we probably need to make some adjustments, unless that portfolio is vastly greater than what you're going to need, and you're only going to need to draw, say, 1-2% out. You've massively overfunded, or you have inheritances or trust funds or whatever. Sadly, that's obviously not most of us. But assuming we're going to need a 4, 5, 6% withdrawal rate, once you get within 10 years, that's really where we start making adjustments for clients, especially 5. So, like for Virginia, if you're going to retire in early 2024, you really need to get with your advisor or someone like Stuart to say, look, first off, and we're going to talk about this later today, how much do we need? Like, how much do we need in income? We need to project out our retirement expenses. And then once we know that number, then we can work backwards to now and maybe start shifting some of that stock. So again, remember, if you're investing in the 401k, and let's say you're in the S&P 500 large cap fund, you're only doing well because the tech funds are doing well. But also, those tech funds don't pay you anything. Most of the tech funds are very low dividend paying stocks. So there's no income checks there. There's no rental income, if you will. So we need to start shifting that to things that are actually paying you checks. So we don't actually always have to sell stuff to get your money. We're just shifting one asset to another. We're basically buying a rental property with no tenants in a Wall Street product into a product that has tenants that's kicking you that income. So make sure you guys reach out to us on that. Like I think last time we did it, Stuart and I probably had 20 or 30 people reach out and say, hey, I don't really have a retirement income plan. I don't know how I'm going to draw my stuff out. I just know I want to retire at 65 or for 3 years or 4 years or 6 years. That's where you'd really want to get with us on that. But yes, if you're 10 years or under, it starts to get, we really want to scrutinize where it is in accordance with what your plan is. And if you don't have one, we got to start there.
Brian, I'll jump in. I know we're getting a couple other good questions in the chat about traditional Roth IRA. When's a good time to make the conversion? I know we'll get into some maybe some items here that are important in Q4. We wanted to spend a little bit of time talking about it, but I think the Roth conversion conversation is interesting. I would say that for most people, making a conversion from a traditional IRA to a Roth IRA is something that's better done early in retirement when you have a very small balance versus later or at retirement. And the reason for that is when your account balance is a lot bigger, making those conversions when you're in a higher tax bracket, kind of at the end of your, we'll call it your peak earning years, which is typically heading into retirement. Remember, anytime you make a conversion, it is going to get reported as taxable income. So a lot of times, I hate to say it, but you've missed the boat in a lot of cases if you're somebody who's maybe trying to play the catch-up game, or you're wondering, hey, how am I going to create retirement income? I probably wouldn't be doing it unless it's part of a broader strategy and you're willing to swallow the tax hits that you're going to have when you're making those conversions. So again, case-by-case basis, I think most people we talk to are going to be in a lower tax bracket in retirement because you're not working anymore. And so in that case, it makes sense to have accumulated that money on a pre-tax basis, pay those taxes in retirement as you take a little bit of money out and be in a lower tax bracket. Again, work with your CPA if you got questions, or we're happy to have a more general conversation with you if you're somebody who's at retirement and you're maybe looking at doing some Roth conversions. So just something to keep in mind. Let's get into the Q4 items. So Brian, I know we talked a little bit about this when we were thinking about what was going to be relevant and just some questions we were getting, what we're talking to clients about as we wrap up the year. I'll let you maybe talk a little bit about tax harvesting. I know that's something that we're really focused on right now. What should people be thinking about with tax harvesting at the end of the year?
Yeah, sorry, not to Stuart, not to jump off one thing. I wanted to hit Nicole's question as far as, would you recommend lowering the 401k contributions to knock out debts? You didn't hit that yet, did you, Stuart?
No.
No. So real quick on that, you got to be very careful with these high interest rates. Anything that's variable, home equity loans, lines of credits, credit cards, especially the national average on credit cards right now is 27%. I read in some article yesterday. That's egregious. So make sure that, yes, if you have those high interest debts that are north of, 5-6%, I that could make sense to go after those and back off the 401k a little bit. Things that are 5, 6 or under, I would tend to, look at it. And that's more the Dave Ramsey pay off your debt kind of financial planning. But again, feel free to reach out to us and go over the debts, and we can help you assess what the best plan of attack is once we know the situation. So yeah, so year-end tax harvesting. So this is why, I have 18 client meetings today or around this meeting, as I was telling Stuart, and half of those are year-end client tax reviews, getting with the client CPA, looking over the investment account we're managing for them, and really preparing and getting their taxation where we want it, because we can control taxation to a good degree so the client's not paying more than they need to. So what tax harvesting means is, let's say I bought one stock at $100 and another stock at $100, two different companies. One went down $20, one went up $20. I have the ability to sell both of them and offset the gain with a loss, so I don't pay any taxes. And we have really good algorithms and partners we use to help tax harvest our clients that have these taxable accounts. So you probably, again, you just Google tax harvesting. It's hard to do on your own. I'll put it to you that way. I even had my own accounts that I tax harvest, because that's what I do for a living. But it's really hard without a system and a structure in place to do it. So that's something that you look at. If anyone on the call has taxable investment accounts, not IRAs, not 401ks, tax harvesting is certainly something you want to get with your advisor or a steward or myself, as well as your CPA. And if you also have a taxable account and an advisor and they're not talking to your CPA, that's not good. That doesn't help you, right? Like, I'm always talking to the CPAs so I know the client's tax situation, so I know how much capital gains they can stomach without putting them into other tax issues.
Yeah, I think I'd add to that, Brian, just kind of along the lines of the tax harvesting conversation, keep an eye on investments right now. So, this is a good time to be reviewing your allocations. I think a lot of times it's not front of mind. So, I know you just briefly touched on it, for somebody that's maybe near retirement, maybe you're thinking about de-risking, looking at your asset allocation right now, I think is something that everybody should be doing. If you're younger, maybe you're set it and forget it a little bit more. But if you're somebody who's getting closer to retirement, making sure that you're looking at those allocations. The other thing to keep in mind, not 401k related, but if you do have flexible spending accounts, remember it's use it or lose it. FSAs or those medical accounts, you're kind of prepaying your medical expenses, if you will. And separate from HSAs, HSAs, those health savings accounts, max those out, for obviously the tax purposes and the ability that you have there to roll that forward. But those FSAs, if there's any elective medical procedures you can do, you got balances there. Get it done before the end of the year is what we're saying. Cash management is also something we're talking to a lot of clients about. We touched on this last quarter, but if you've got money just sitting in a bank right now, brick and mortar, you're burning cash, or you're losing the opportunity for easy money. There's not many things that, there's really nothing that Brian and I can say that's a guaranteed rate of return in our industry, right? But when it comes to high yield savings accounts, those are FDIC insured up to $250,000. The rates on those are what I want to say around 5% right now that we're seeing for most of these, between 4.5 and 5%. And if you have money in the bank, you're getting what, 1%? So the bank's taking your money, they're loaning it out to somebody on a home loan at 8%, and they're giving you 1%. So they're making the spread on that, and that's going right to their bottom line. If you're in a high yield savings account, then hopefully you're getting close to that 5% range. So if you haven't looked at those, highly recommend doing it. I know there's more people that are open these accounts now with rates where they're at, but it's definitely worth looking into and making sure you're just being very efficient with any cash that you have on hand.
Yeah, I mean that's a biggie and it's often overlooked. Look, our pieces of paper with presidents' faces on them lose value every day. With the way the government and the Treasury spits out dollars and the way they spend, the way they send money overseas, the way the exchange rate works, the way the way the currency exchange works, inflation, and on top of that, as we know, inflation's been very bad for a couple years. So we want to make sure with every ounce of our due diligence that our bank dollars we're giving to the bank, that they're loaning out 6 or 7 times to make, max leverage return as a for-profit bank. We're getting at least 4.5%. So if you don't have 4.5+% in the bulk of your liquid FDIC dollars, you want to assess those banks. I just talked to a client of mine earlier today. She just came into some money and had it in a Bank of America account at 1%. Now she's north of 5, fully liquid. So
yeah, Brian, I mean, we're getting a few questions here, and we're obviously not paid by any banks to endorse them. I think a lot of the online banks have them. You can very easily do a Google search in terms of high yield savings account. I think Amex has a good one. It's north of 4%. Maybe you've got credit cards with Amex. It's easy to open up a high yield savings account. Ally is another kind of online bank that's got good rates, and then SoFi, the student loan consolidator. Kind of a lot of people know SoFi because it's the Rams stadium, right, out here in LA, the big new stadium they built. So, those rates I want to say are right in that 5% range. So you can easily Google this. I'd say maybe start with your credit card company, like if you're banking with a Citi or an Amex, and see what they have. It's fairly easy to open, and there's not really a downside here. They are susceptible to interest rates, so it's not like you're going to get the 5% in perpetuity, right? If rates are to go down eventually, then these yields are going to be lower as well. But again, at least you're capturing that upside while rates are high. If you got money just sitting there, maybe it's your emergency fund, something along those lines, put it in a high yield savings account. What do we, Brian, this is top of mind for us, but kids' college planning, we've talked about 529 plans in the past. What should people be thinking about there, wrapping up the end of the year?
College accounts? Yeah. So for those of you on the call with kids, myself included. Oh, we got a little background noise here.
Which is why I would just rather.
Guys, make sure you mute your lines. So for those on the call that have kids, myself included, 529s are college accounts where a certain amount of money can go in pre-tax and state tax, mind you, in many states around the country. So depending on where you're joining us from, I know obviously I'm sitting at my home office here in Maryland. There's a $2,500 per account per beneficiary tax deduction. So my wife and I have one child, so my wife and I both have 2 accounts, one in our name, one in the child's name, but we make sure we max that out before December 31st. So if you're saving for your kid's college and you're doing it in a 529 fashion, again, just make sure you're aware of what the limits are. If you're financially in a place where you can max those out and save those tax dollars, make sure you do that. Some states don't give any deductions. Some states give unlimited deduction. Maryland's kind of one of those ones. It's kind of nominal, but if you know the tricks and you do multiple accounts, it's per kid per beneficiary. It ends up being close to $1,000 in tax savings for me. But you got some states. I think New York's 10. I want to say West Virginia is unlimited, but there's states that have sizable amounts of these things. So that's something that you want to check. If you're just kind of auto saving, every month money's going in, which is great. It's too late if you check it in January. I'm like, oh man, my CPA said I should have given more. Watch that as well.
Yeah, no, it makes sense. CPAs, tax projections, we talked a little bit about that. I mean, those are really the top items I think that people should be thinking about at the end of the Q4. The other thing I like to talk to folks about is just, Q4 tends to be one of the more expensive quarters. And I say that, maybe property taxes are due if you're not impounding those. There's a lot of holiday spend that happens, right? Food and family activities tends to blow up the budget a little bit, so to speak. So, just making sure heading into the holiday season that you're really Not that you shouldn't spend more on certain activities, but make sure you're budgeting for them. Make sure you've got that money. Don't go into debt around the holidays, right? If you're somebody who's maybe making choices and trying to be intentional about how you spend money, it can get easy to get pulled into a lot of stuff and start spending a lot of money over the holidays, putting on a credit card, and then find yourself in a bit of a hole when the first of the year comes around. So it's just kind of a blanket statement I like to remind people about it at this time of the year. It seems like every holiday season, at least the last few years, has been a lot more expensive. So I don't think it'll be any different this year. Let's talk a little bit about just some things people can do to maybe be more efficient just in their day to day. I know insurance premiums are something that's really top of mind for a lot of people. Costs just seem to be going up. A lot of places are dropping coverage. If you're in Florida, you've probably seen this. A lot of insurers are pulling out. I'm in California. We're seeing the same thing. It's harder to get even home insurance here with the wildfire risk we have. Just from time to time, it's good to benchmark what your costs are in certain areas. I think insurance is definitely one of those areas. So, keep an eye on what you're paying. Maybe it's good to shop around a little bit. Benchmarking your reoccurring expenses once in a while can be a great way to keep your costs down. And it's something we do on the investment side for a lot of our retirement plan clients. We benchmark the fees that people are paying against, what's out there in the industry. And you should think the same way about your household finances. Run your household like a business is the best advice I can give you. So be looking at some of those premiums that you're paying on an annual basis. Look to maybe shop around, see if you can save some money for comparable coverage. I don't know, Brian, you want to add anything there?
Yeah, sorry, my internet dropped off. I just got kicked out there for a second. I apologize. So I missed a little bit of what you were saying.
Yeah, no, just talking about benchmarking insurance premiums. Like where would people start for that?
Yeah. So, oh yeah, sorry. Yeah, I don't know what happened to my Wi-Fi there, but yeah, that's a biggie right now. I can tell you my own. I had Chubb for my personal lines, and then I had my office shop it last year, as they do every year because we do all these services. And my team ended up moving me to Travelers. I saved a good bit, and then this year Travelers put me back to where the premium I had with Chubb was. So you're seeing continual upward movement in premiums on property casualty, and this goes for commercial, it goes for residential, certainly coastal, absolutely Florida. A lot of carriers are out there, so that's something to check. I mean, I would venture to guess half of you are getting increases in your property casualty because they're just the insurance companies are breaking out the risk of all these storms and natural disasters across all business lines. So that's something we can do very easy. Like I said, a client yesterday, they got an increase, so they just send us their declaration pages and we'll just shop all the carriers. It's dozens of them that we have access to. The only carriers we can't shop, right, are the captives like the USAAs and the State Farms. You got to go to a State Farm person for State Farm. But it's pretty easy to do. It's just a matter of getting your driver's license and the deck pages. But another part of why you would do that is making sure your coverages are right. A lot of times people are very underinsured on their home. If their house were to go down in a hurricane or a tornado or something, a lot of people have improper coverage, and especially people with kids, they have improper umbrella coverage, which is a property casualty line you get over and above to cover liability for your home and car insurance in case something were to happen, and that's something a lot of people don't have in place is umbrella insurance, or they have not enough. And it's a very, very low cost insurance, but things like that are important.
Yeah, no, good point, Brian. Let's switch gears here a little bit. I think everybody in the call is probably, they're in some way, shape, or form tied to a retirement plan that's offered through their employer. So, I know we talked about it in a more general sense, but let's get into 401ks, 403bs, retirement plans in general. I know retirement planning is probably the number one thing we're asked about, and we get questions around when it comes to doing these shows. So real on a high level, want to talk about retirement plans in general. They're a phenomenal vehicle. They're sometimes not going to be the most efficient when it comes to distributions. So meaning when you get into retirement, how you go from accumulating and buying into those investments to decumulating. That can sometimes you give up some efficiency there for the scale and the cost benefits that you have by being in the retirement plan. But they're going to really be, I think, at this point, they're the vehicle of choice right now that Americans have access to. It's 401ks. It's very standard. So when we are working with a lot of clients right now that are thinking, retirement is on the horizon, like it's within the next 5 to 10 years, there's obviously a lot of conversation around retirement income planning. And right now, with the volatility that we're seeing in the market, there's a lot of opportunity, I think, for more of the guaranteed products. I know there's a lot more commercials. You start to see things, and I think in the past, Brian, I know we've had clients that have asked us or been very resistant to annuities. Like it's almost kind of like a bad word in the industry.
Yeah.
Maybe you've been sold or pitched an annuity in the past by somebody who's not a fiduciary. They're just selling insurance products. They're not going through a due diligence process to get to know you, your suitability, when you're going to need the guaranteed lifetime income. They're just selling you annuities. So I think it sometimes gets a bad rap. But right now, I mean, frankly, this is a good time to be looking at them. So a lot of clients that we are seeing now have purchased annuity products. And again, this is all in line with guaranteed lifetime income. They purchased these products over the last several years with the intention of creating that guaranteed lifetime income stream when they retire. And the reality is with these lifetime insured products, they are very heavily tied to interest rates, which means if you took out an insurance policy when rates were at 0 or 1% over the last, we'll call it 5 to 6 years, the ability to upgrade that policy right now where rates are at 5%, there's a huge margin there. So we're seeing clients now that bought policies, as little as 2 to 3 years ago. They haven't turned the income component on, but now if they were to get out of that policy and get into a new policy, it's tens of thousands of dollars more a year in guaranteed lifetime income when they flip the switch. So, Brian, maybe talk a little bit about how we could help in this area, because I know there's probably people on the call that have purchased annuities in the past. Maybe they're getting a statement every month, but they're not really in the income phase yet. What could they be doing?
Yeah, so let's just high level first, right? When you guys invest in, and myself included, when any of us invest in 401ks, we're investing in mutual fund Wall Street products. So those products provide us no guarantees of what our account's going to grow to by the time we retire, right? And they also provide us no guarantee that the money won't run out once we start taking income. Mutual fund products just don't do that. That's not what they're designed to do. Annuity products are insurance-made companies where you're buying guarantees for something, right? Just like you're getting health insurance and car insurance. Like there's a contract of what you're getting. So in the past, with interest rates being as low as they were, the guarantees on these kind of products, bank CDs, insurance annuities, they weren't very advantageous. But take, for example, let's say you're invested in a Vanguard 2025 mutual fund, right? So it's about, and that's what a lot of retirees and 401ks are in, and they plan to retire in 2-3 years. So that fund, just for looking on Morningstar right now, in the last 10 years, year over year, it's done 5.4%. And last year, being a down year, it lost 15. So it has the ability to drop, and it's average 10-year 5.4. The fixed annuity space right now, you can get an annuity that locks you in for 10 years at north of 5.7 towards 6%. There's one that came out yesterday at 6%. So some clients are saying, and this didn't exist 2 years ago when interest rates were where they were. So some clients are saying, hey, well, why would I take the risk of being able to lose 18% in this portfolio if this one's already only giving me 5 anyway, and I can shell off that risk. So that's why you're seeing more money that have come into annuities so far this year than have ever come in ever before by a vast margin. So a lot, that's just to Stuart's point, I've been doing this 20 years. We have a lot of clients with a lot of annuity products as well where they were suitable. And we've ended up flipping a lot of them. We've gotten them out of the ones they were in and gotten them into the current ones that are locking in the rates. So you're seeing that quite often where people want to shift from an accumulation type vehicle, which is mutual funds, stocks, ETFs with no guarantees, and they want to switch into that insurance world where they have that guardrails for some amount, right? They want to, but between my Social Security and my income from this protection account, I want to have X. And then beyond that, I can have my checking, my saving, and my wealth management that goes up and down, et cetera. So it's all, is it a piece to part of your plan? And at 22 high-year interest rates, a lot of people right now, for the numbers we see going into those products, the answer is yes.
Yeah, I think a lot of people, they don't realize that the market has changed so much. So a lot of the people that we're coming across that have these types of policies, to Brian's point, they bought them several years ago. They haven't flipped the switch on them. They're sitting in an old product when as literally as easy as just getting out of the old product and into the new product, it's a significant more, a higher amount, I should say, of that guaranteed lifetime income. So, I mean, that's something if you want to get an independent look at, we're happy to have that conversation. I know we'll put the, did we put the email yet in the chat, Brian, for
I
the
put
planning email?
mine. Yeah, if I think Kelly's on, maybe if Kelly can throw it in
Yeah,
there.
we'll throw the planning email
We'll throw
in
it
there.
in
But
there.
if you're sitting in an old insurance product, and a lot of the insurance products maybe have additional riders. So I know we've got a couple questions in the chat. Nicole asked about long-term care insurance. You know, a lot of times those are riders in annuity products or just in other insurance products. They're kind of wrapped in there. So this would kind of fall into the same conversation, right? You probably purchased an old policy. It was at a much lower interest rate, and that's tied into the benefit that you're going to be receiving when you would go into a long-term care like scenario. So something, you know, it's just something to be thinking about. It's a fairly easy benchmarking process. We can look at things fairly quickly and give you an idea of whether it makes sense to hop out or to just stay with the one you're in based on your personal situation. I think we had a couple questions come in.
Yeah.
If it's worth circling back, you know, just in terms of the housing market, you know, I don't know. We want to add any color on what people should do if they're thinking maybe I want to buy a house.
Yeah, I just gave a seminar for one of my groups on real estate investing yesterday. They were very interested in real estate investing, and the housing market's interesting because interest rates yesterday for the first time in I don't remember how many years it's been, but they just hit 8% on the 30-year fixed. Yesterday was the biggest jump it's been in the last, I don't know, 7, 8, 9, 10 years, whatever it is, since they were that high before. They hadn't hit 8 yet, and yesterday they actually hit 8. So a 30-year new home mortgage is at 8%, and 2 years ago it was sub 3. So that changes things a little bit about the affordability. And you look at homes prices, they haven't really gone down because the supply, and it's still hard to get some things to build homes, even post-COVID with supply issues. So now you're seeing a lot of commercial buildings almost foreclose on purpose and lose their zoning on purpose so the developer can flip them into condos because a lot of the work from home era post-COVID. So we would hope that you'll, and again, from what Powell said today, we don't think it doesn't sound like interest rates are going down for a while. So if you're in the new market housing space, getting a good realtor is extremely key because you're going to start seeing mass exodus of people, not, you know, variable interest rates that are going to get flipping now on these high rates. They're going to have to sell all these new HOA reserve studies. So a lot of people with condos are getting massive increases in their HOA fees. A lot of them are going to have to sell. So having a good realtor in on getting access to things that aren't always on Zillow before, you know, things before they get listed, that's probably one of your best bets. Stuart and I have a national realtor network. We could always try to help you on those kinds of things. But that's probably where I would keep my eye out. But yeah, the housing market's interesting. We're really shifting from a, you know, massive, what is it? In the seminar, it was 20% of mortgage loan officers in the last 6 months are gone. They've left the business or been dissolved altogether. I feel a lot of the bank clients we have, they just totally closed their mortgage division. It's gone. So there's just not as much activity for people getting mortgages. So because of the rates, obviously. So if reach out to us, we're happy to help with those kind of things. Let's see some other questions here.
Yeah, I wanted to touch on a couple things and more of a clarification. You know, we talk about high yield savings. You know, if you had money sitting in a 401k plan in cash, we're not suggesting you cash out your 401k and moving it to a bank high yield savings account. I mean, that's going to create a significant tax liability. We're you know, purely talking about after tax money that you've already got maybe sitting in a bank or financial institution, not in a qualified retirement plan. So, you know, be very careful about moving money around from retirement plans and getting out of those tax qualified vehicles into something that's a you know, an after tax type account, because that's going to trigger tax liability. So just, you know, if you're getting near retirement or you're thinking about creating that income stream, you do need to be very cognizant that with these tax qualified accounts, it needs to be done in the correct way. So again,
Yes.
reach out to us, reach out to another financial professional and get some help. We've seen some bad actors there, and you really want to just make sure it's done correctly.
Very good disclosure. But again, I'm seeing a lot of our retirees that age 60 in our plans that say, hey, why sit in a long-term vehicle that goes up and down and the 10% returns 5.5% when I can just go get, you know, north of 5.5%, 6% fixed, or I can go into a lifetime income annuity product and get, my wife and I can get 6% draw for life guaranteed by the insurance carrier. So you're seeing a lot of folks moving that way, just not wanting to deal with the volatility anymore and have that reliable income stream and not have to guess and check and hope that the money's going to be there. In our industry, it's what's called a Monte Carlo analysis, where basically you got a 60-40 portfolio and we run it basically on all the historical data points of the stock market, like 10,000 scenarios, and it gives you a probability that if I draw out 4% and I live to age 90, based on historical, which doesn't guarantee, but based on historical, I might have an 86% chance of getting there. People are like, well, why would I do that when I can go now get 6% withdrawal and it's 100% guaranteed by an insurer? So you're seeing a lot of those dollars going there again because of interest rates as high as they are. Let's see what else we have here. Financial budgeting tips. Oh, actually, someone asked earlier, I said I would hit to it. Indexed universal life. So my thoughts on that. So indexed universal life is a type of life insurance that is basically, that has a investment component tied to the market. And obviously it can go up with the market, but really can't go down. There's basically what's called a cap rate on the S&P. So there's an internal growth component, and typically it can be used and or I want to say sold by some insurance, just pure insurance people that, tax-free retirement income. And it can be, but you need to design it in the right way. And there's a lot of insurance carriers, so some that are really good in that space. So there's a lot. I mean, look, all the insurance carriers, well, not all of them, but the vast majority provide IULs, and they're not all designed the same. They have different cap rates. They can lower the cap rates. They have different minimums. They do different things. So they can be a good fit in a scenario. I have a client. My meeting today is at 6 o'clock with a client of mine, an executive that he needs life insurance, and he already maxes out his 401k. So we're going to probably use an IUL, a specific one that I know that is a good income retirement tax generator. It's much more tax efficient than just drawing out money out of a 401k and paying ordinary income tax. So it can be a good weapon. It just needs to be designed correctly.
Yeah, and there are a lot of bad actors. I think the knock that the annuity and the guaranteed lifetime income people get is, again, it's not a securities licensed product in a lot of cases. A lot of people will get an insurance license and push just a specific product, and they're not really doing a holistic planning type conversation. And a lot of times, a very rosy picture can be painted with a lot of the hypothetical analysis, when in actuality, when you factor in market returns, it just maybe isn't going to live up to the hype when you get into those variable in nature products. So something to keep in mind. That being said,
and on that end, so Stuart, the other thing with us obviously is, again, we're at NFP, we make zero products. We're totally agnostic. So we have access to all the different lines of all the different carriers of all the different products. Like, I'll give you a perfect example. I had a client who was buying a lifetime income account for him and his wife. They're 60 and their joint lifetime income. They get a 10% simple roll up on the income base for the next 5 years. So no market worries. And then they get it's like a 6.5% for life off of what it grows to. And as of yesterday, I just found, but before he did the e-sign, another carrier just upped their rates. So we voided it out and we're switching to that new carrier. So you just want to be with someone that's independent to sift through all these products, whether it's long-term care or CDs or whatever. But and we're not the only people that can do that, obviously, but that's always good to stick with folks that have full freedom to go out into the market and figure out what's best for you.
I got a good question. So, again, this is a service that's provided by your employer to have a conversation with you, to look at your finances. We're not charging you a fee to have a conversation with us. I mean, Brian and I want to make that really clear. I mean, I feel like at this point of doing the show the last, 2-3 years, we've had conversations with hundreds of people. And, that's certainly something that, as a WellCents participating organization like yours is, if you're attending this call, we're happy to provide that service for you. So you're not getting an invoice from us in the mail for our time to get you pointed in the right direction. Just some good, I think a good conversation here would be on target date funds. We're big believers in target date funds and 401k plans, retirement plans in general. I think that most people, I believe the study that Fidelity, big financial services company, did found that more than 90% of plan participants were not making changes to their investment accounts, but once every 7 years. So by and large, people were, setting up an allocation. They weren't really monitoring it. And then maybe when they got around to it, 7 years down the road, that's when a change was being made. So I think a lot of people like to think, hey, I'm very involved in this. I'm going to be making changes and be dynamic with how I'm managing my 401k. But in actuality, that's not what happens. And so the good news is, and the reason behind target dates is that they're rebalanced for you. They're adjusted annually, and over time they continue to get more conservative as you get closer to retirement. And that's really, it's maintaining a appropriate level of risk for someone, rather than have them get too aggressive or experience more volatility as they get closer to needing the money. So Brian and I, we're big believers in target date funds. I've got a good amount of my 401k assets into a target date fund. I think it's a great hands-off approach. And of course, as you do get closer to retirement and you start to look at the full suite of other resources that are out there, is it part of the conversation? Yes. Is it going to be a good fit for everybody? There's not a single product that would check every box, right? But I think for most people, target date funds are a success story of the 401k world, I would say, over the last 15, 20 years. I don't know, Brian, you want to add anything?
No, I totally agree. Look, I mean, mutual funds, ETFs, stocks, these are long-term appreciation-focused strategies with zero guarantees on them. That's where all my money is. I'll be 40 years old this year, so I mean that's where all my retirement dollars are. It's different types of products for different types of things, and those are gold in the growth years. When focus starts shifting towards needing income, they're not generally the best. But especially in mutual funds and such, there's better funds and stuff you can pick that are less growth oriented or other kind of products in general that help you shift to that point. I did see Kathy had a good question on long-term care. I hadn't written a lot of long-term care policies in years because the premiums are astronomical, and with interest rates rising as much as they are, annuities are not the only insurance products that are flying off the shelves. Life insurance, long-term care insurance, because ultimately, remember, the insurance companies, I don't want to say this word, but they're like a bank in the respect that it's always just about driving more income, right? So they're just giving you a contract, but all they're doing is they're taking their money out of your pocket and getting it to theirs, and they're buying bonds and they're investing, but now you have a contract that they owe you this from a quality carrier, right? So what matters the most on this long-term care stuff these days is the premiums are less. But a lot of people don't like the long-term care, straight long-term care, because you're always getting premium increases. It's the whole use it or lose it car insurance. It gets more expensive. They keep raising it on you throughout retirement, and it becomes tough on a fixed income. Most of I'm writing 4 long-term care policies right now for clients, and we're using hybrid policies for all of them. And what that means is, it's not a use it or lose it. So you're paying these premiums either in a front load or over 10 years. They can't raise the premiums on you. If you die tomorrow or suddenly and never need long-term care, it pays out as life insurance. And then if you win the Powerball or get an inheritance, you can go and get some or all of your money back and just cancel the thing. So your money will get used for something. Those tend to be much more well received than just doing the straight long-term care. But it is a big conversation in my industry. We call long-term care the portfolio killer. For example, I got a client of mine in their 80s, horrible, but he's got some mental things going on. He's in a mental ward, and it's $15,000 a month. Like, we didn't budget for that. But having long-term care, doing asset protection, trust planning as an estate planner that we do, those kind of things can shield and not disinherit the surviving spouse. So it is important. The best time to buy long-term care, typically 55 to 60. I know we mentioned annuity products. Those really aren't suitable unless you're typically 55 to 65. So those are where kind of the sweet spot are. They're not really, those 2 products aren't really suitable for people under that, minus a few certain scenarios. So back to Stuart's point on the funds, it really depends on what part of your wealth building career you're in and/or wealth drawing career about what products make the most sense.
Yeah, no, good point. Let's take a couple more questions. I don't know if we missed anything in the chat, Brian, but I know we're coming up on time. I think what we kind of want to leave you with is just, hopefully we've covered a lot of ground. Obviously, with everything going on in the market right now and just broader economically, it's a good time to be looking at your finances. I mean, that's something that we always want to focus on. Your time is valuable. I know, Brian, it's one of the quotes that I've enjoyed hearing from you, that time is your most valuable asset, and that's the truth. So I think for a lot of us, the reason we're saving, the reason we're investing is we're trying to buy time. It's time with our family in retirement. It's time with the grandkids. And so making smart financial decisions today while we're working, that's what really translates into that ability to have that time down the road. So make sure you're doing your due diligence. Make sure this is top of mind. go into retirement with a plan. The plan can obviously change. A lot of times it does, but you want to be cognizant of and put the time in on the front end so that you can have that enjoyable outcome down the road. So that's it for me. Brian, you want to have any final thoughts here before we let people get back to their Thursday?
Yeah, look, I mean, ultimately, again, Stuart and I are salaried out of the costs that come from all the plans to do these, and honestly, I'm sure Stuart would agree with me. I do it for free because there's so much misinformation out there. There's so much biased information in front of your face. We are here to give you totally unbiased advice from a firm that makes zero products whatsoever. And again, we've been doing these now for 2 years, and we'll have calls all the time that come from these, and we'll take 30 minutes of our time. We're happy to do it. And like, I have clients, or I've had people that have called, not clients, but people that have called me from these, and like, Brian, we really appreciate it. We had $100,000 in an inheritance sitting at 1%, and you helped us get 4.5, and we made $4,000 for 30 minutes for you helping us over the phone. We really appreciate it. That's what we're here for. You guys have your families, your friends, your jobs. If this isn't your thing, you don't know all this stuff, you don't watch it every day. That's why we do these, to keep you up to date with what's going on in the market, where can you get some value, what makes sense, what makes sense to look into, right? Like, for example, if you have an annuity in your portfolio at all and it hasn't been looked at in 3, 4, 5+ years, you'd want to call us. And we'll assess if keeping it makes sense. If you have a bank account and you're not sure what it's returning, check into it, and we can send you some options of what ones you could open to do it. So knowledge is power, right? And the more knowledge we can get you guys, and getting your feedback, and that we really helped you and your net worth is growing and not going the other way because of what we told you, that's how we get paid, honestly, is the enjoyment of knowing, whether you guys are clients or not directly, that your life is better because we have these meetings.
Yeah, great insight. So on that note, I think we'll wrap it up. We'll see everybody in 2024. Finish the year strong, and thanks for your time.
Yeah, thanks everybody. Have a great week.
Thank you.